morning and welcome to your morning market hit for Friday the 15th of July. What matters today for traders? What an interesting time it is to be in markets right now. The US macro picture is deteriorating sharply, inflation is soaring, consumer confidence is at 40-year lows, liquidity is tightening and the yield curve is inverted. So with that backdrop, company earnings are surely being revised lower. Well, they aren't. Indeed, 2022 earnings estimates and 2023 continue to be revised higher. They're now predicted to grow 12.6% this year. So are these predictions overly optimistic? Earnings expectations are obviously a crucial part of equity market direction, so it really pays to stay on top of the trends in earnings reports as and when they come out. Of note, earnings season kicked off yesterday in earnest, with JP Morgan and Morgan Stanley reporting. So what tools can we use to predict and analyse these trends? Well, on a daily basis, we're tracking reports as they're released and tracking the surprise. That's the earnings and sales relative to expectations. We also have a number of other models we track. One example is our revisions index, which tracks when analysts publish changes in their earnings forecast for US stocks. Encouragingly for the bulls, our revision index remains in positive territory, so it's not yet signalling a deterioration in breadth of earnings outlooks. Another is our guidance index. This tracks when US companies release forward guidance ahead of earnings reports, often to mitigate the downside surprise. Less encouragingly, this has fallen sharply in recent months, with high-profile negative guidance from key tech and fintech stocks such as eBay, PayPal, Cisco and Micron. Well, it's all well and good having this top-down perspective and models on earnings, but how do we actually trade and make money out of that? Well, that's where our models come in. The message of those models with the top-down perspective, well, that's the real value that the Daily Rag adds. For more info about the Daily Rag and a link to a 7-day free trial, please see the description below. One final chart you might find interesting is the typical S&P 500 behaviour through earnings season. As you can see, it typically chops sideways for a week or so, and that's because it's the banks that are reporting in this first week, and these don't generally give a good read on the economy as a whole. It's in week 2 and 3 where key industrial, mega-cap tech companies start reporting, which marks the beginning of the market outperformance over the past couple of years. Of note, Apple reports on the 28th of July. That's the 10th day of earnings this season. That's all from me today. Do remember to like and subscribe to stay up to date to all of our latest videos. Thanks a lot for listening. Have a great day.